Yeah, good afternoon, everyone. I am CA Parminder Kaur, Secretary Accounting Standards Board. I welcome you all to today's webinar on accounting standards for non-corporate entities. Today's webinar is conducted primarily to address the financial reporting requirements for non-corporate entities. Considering the scale of operations and ease of implementation of accounting standards by non-corporate entities, these entities have been classified into 4 levels, and certain exemptions, relaxations have also been given to small, medium and micro non-corporate entities. In this regard, Institute came out with an announcement in March 2021 with regard to revision in the criteria of applicability of accounting standards to non-corporate entities. So today we will focus on this announcement of the Institute and few standards primarily related to assets which we considered are very much relevant for most of these entities. So with this, we move on to the first session for today's webinar, which is a brief discussion on announcement with respect to criteria for classification of non-company entities for applicability of accounting standards, which will be taken by CA Dr. Alok Garg. So I'll invite CA Dr. Alok Garg to take this session, who is a regular faculty of the Institute for various programs on accounting standards and Indian accounting standards. He is also a regular faculty of our certificate course on Indian accounting standards. He is visiting faculty of University of Delhi and University of Udaipur for diploma in IFRS and other institutions and public sector undertakings. He is well-known author of various books on Indian accounting standards. He has been awarded with National Education Leadership Award from Delhi University in association with Indian Accounting Association. He has relevant experience in the field of financial reporting, consolidation and auditing for more than 14 years in multinational Indian corporate and CA firms. So with this, I'll invite Alok Garg to take the session. Over to you, sir.
Thank you, Parminder ji. Thanks for the nice introduction, and thanks Accounting Standard Board for giving me this opportunity. So let me share my screen, and Parminder ji, please confirm if my screen is visible.
Yes, Alok ji, it is visible.
Yeah. So good afternoon, participants, and good afternoon, ladies and gentlemen. So before starting this particular session, let me talk about the accounting framework in India. Then I'll jump on to my session. So as of now, there are 3 accounting framework which is prevalent in India. One is Indian Accounting Standard, which is nomenclated as Ind AS. The second one is Accounting Standard, which is issued by Ministry of Corporate Affairs, which is largely for companies. And the third one is Accounting Standard issued by ICAI, which is largely for non-corporate entities. So out of these 3 accounting frameworks, today we are discussing about accounting standards, applicability of accounting standards for non-corporate entities which have been issued by Institute of Chartered Accountants of India. So in today's session, as far as agenda is concerned, so we will discuss about criteria for classification of non-company entities for applicability of accounting standard. ICAI in its council meeting, 400th council meeting, which was conducted on 18th or 19th March, has decided to change the criteria for classification of non-corporate entities for some reasons. I'll discuss that, which is related to applicability of accounting standards. Then we will be discussing about the reasons for consideration and review for the criteria for classification of these entities as far as applicability of accounting standards are concerned. Then we are going to discuss what are the changes as far as criteria for classification of non-corporate entities is concerned, and what are the applicability of accounting standard on these set of entities. So first of all, let me talk about why the classification criteria has been changed. So earlier when we were talking about the applicability of accounting standard, largely we were discussing about small and medium enterprises. So there are 2 accounting standards, one which is issued by MCA for the purpose of companies. The second one which is issued by ICAI for the purpose of non-corporate entities like partnership firm, Hindu undivided family, LLP, your proprietorship firm, body of individuals. So the enterprises which are non-corporate entities, they have to apply accounting standard as per the announcement or as per AS which is issued by ICAI. So earlier we were talking about small and medium enterprises, and these small and medium enterprises word has been used on a different aspect according to different purposes by different regulators, government bodies and ICAI. For example, ICAI used this word small and medium enterprises for the purpose of accounting standards. MCA used this word for the purpose of applicability of accounting standards for the corporate entities, not for the non-corporate entities. And the Ministry of Micro, Small and Medium Enterprises is also using this word MSMED for regulating these entities, and RBI is using for the purpose of banking facilities. So these different government bodies have different purposes for using this word small and medium enterprises. There were no uniformity, and the word small and medium enterprises has been used for different purposes, different aspects for which they are meant. So according to this announcement or clarification by ICAI on 31st March 2021, the ICAI has also amended the criteria for applicability of AS for non-corporate entities, and they have also classified this entire non-corporate entities into 4 levels. When I say 4 levels, from small and medium enterprises, now they are nomenclating it as a micro, small and medium enterprises. So now this word SMEs has been replaced with micro, small and medium enterprises, MSME entities. So according to this particular classification, according to this particular announcement, the major change was earlier there were 3 level of entities, level 1, level 2, level 3. Now there are 4 level of entities, level 1, level 2, level 3, level 4. So level 1 is large entities, level 2 is medium entities, level 3 is small entities, and level 4 is classified as a micro entities. So now we have a micro, which is level 4, small, which is level 3, medium, which is level 2, and level 1 is nomenclated as a large entities. So we have 4 classification in place of 3 classification which were earlier. So effective 1st April 2021, there are 4 classification for non-corporate entities from the accounting standard applicability perspective. So these entities are referred as micro, small and medium size entities. So there is a new level which is created, of course, which is a level 4, and this level 4 is nothing, it's a micro non-company entities. So in this particular classification, first of all, what was the reason for the change in classification? So we understood the first reason was to include micro entities, to replace this small and medium enterprises thing to micro, small and medium size entities. The second reason, because some entities, if I talk about non-corporate entities, some entities are very small entities. And in today's world, 10 crore turnover is not a big number. 50 crore turnover is probably not a big number. And whenever I'm talking about compliance, so compliance is generally attached to cost and complexity. Okay. So I'm not saying that compliances should not be there. Compliances should be there, but balanced compliances should be there. So with this view, level 4 has been created, which is a micro entity, and some more exemptions and relaxation has been given to level 4 entities. And of course, when I talk about the criteria for classification of these set of entities, the turnover limit and borrowing limit has also increased for the purpose of classification, which we are going to discuss later on. And certain accounting standards have been exempted to level 4 non-company entities. If I talk about level 4 entities, out of 27 accounting standards, 11 accounting standards are not applicable to level 4 entities. So if you are the auditor of level 4 entities, or if you are accountant of level 4 entities which are falling into level 4 according to the threshold criteria of turnover and borrowings, you are not required to apply 27 accounting standard. You are required to apply only 16 accounting standard. And when I say 16 accounting standard, there are some exemptions, some relaxation is given out of those 16 accounting standards as far as disclosure is concerned. So first of all, 27 minus 11, 16 is effective. Out of 16, in some standard, there are some disclosure relaxation has also been given to level 4 entities. Likewise, in level 3 entities, 9 accounting standards are not applicable. So if you are auditor, if you are accountant of level 3 entities, In that case, you are not required to apply 27 accounting standard. On that particular entity, 27 minus 9, 18 accounting standards are only applicable. And out of 18 accounting standards, some disclosure relaxation has also been given there. When I talk about level 2 entities, so of course level 2 entities, out of 27 accounting standards, 7 accounting standards are straight away not applicable. So 20 accounting standards are applicable on level 2 entities. And when I say level 1 entities, so level 1 is of course a large entities, and on large entities all the accounting standards are applicable. So we have discussed the compliances in terms of a quantum. Okay. So in terms of quantum, level 1, all the accounting standards are applicable. When I say all, it is 27 accounting standard effective as of now. Although the number is AS1 to AS29, but accounting standards are not 29. AS6 and AS8 has already been withdrawn and deleted. So on level 1, all 27 accounting standard. On level 2, 20 accounting standard. On level 3, 18 accounting standards. And on level 2, 16 accounting standards. So these are applicable to these set of entities. So certain additional disclosure exemption have been provided to level 3 and level 4 non-company entities. As I have told you, the specific exemptions we will be discussing. So non-company entities to be classified into 4 levels. As we just discussed, level 1 will be large non-company entities. Level 2 will be medium sized non-company entities. Level 3 will be small sized non-company entities. And level 4 will be micro, medium, small and micro non-company entities. Level 4, level 3 and level 2 entities are referred to as micro, small and medium sized entities. So now we need to discuss what has been changed. So comparing to the earlier classification of level of entities, as a level 1, level 2 and level 3, 3 levels have been shifted to level 4. Okay, that was a big change. The second change, so earlier we have discussed if an entity, which is entity whose securities are listed in India or outside India, so that is classified as a level 1 entity. If the entity is a banking company, it is a bank, not banking company, it is a bank or financial institution or an insurance entity, then it has to be classified as level 1 entity. There is no change in these criteria. These criteria still holds good. If I talk about the third criteria, if the turnover of the company, if the turnover of the entity is at a certain level, then we need to decide, is it a level 1, level 2, level 3, level 4. So if I talk about the existing criteria, when I say existing prior to 1st April 2021, if a entity whose turnover is exceeding 50 crores or borrowing is exceeding 10 crores, okay, if the turnover excluding other income is exceeding 50 crores or borrowing is exceeding 10 crores, then it will be classified as a level 1 non-corporate entities, and all the accounting standards are applicable to that set of entity. You can see on the screen, this limit has been increased 5 times, multiple of 5 times. This 50 becomes 250, this 10 becomes 50. So multiply by 5. 50 multiplied by 5, 250. So according to the revised criteria, if there is a turnover of an entity, when I say turnover of the immediately preceding financial year. For example, if you are the auditor of a non-corporate entity for 21-22, you have to see the turnover for 2021. Okay. So if the turnover of 2021 is exceeding 250 crores, in that case, it will be classified as a level 1. Earlier it was 50 crores. Or if the borrowing at any time during the previous year is exceeding 50 crores, then it will be classified as a level 1 entity. So there is a big change in the threshold of turnover and threshold of borrowings. Okay. So coming to the level 2 entities. Earlier it was exceeding 1 crore but does not exceeding 50 crore. 1 crore is a very small number in today's world. So this 1 to 50, so it means not exceeding 50 and exceeding 1 crore. So this limit has been multiplied again. This limit, this 50 crore, this 1 crore limit has been gone up to 50 crores. So if the turnover of an entity is exceeding 50 crore but does not exceed 250 crores, in that case it will be classified as a level 2 entity. So earlier you can see that earlier if the non-corporate entity is having a turnover of 2 crores, then it will be classified as a level 2 entity. But as of now, if the turnover is more than 50 crores, then it will be classified as level 2 entities. But of course it should be up to 250. So for example, if the turnover is 250 crores, so whether it will be level 1 entity or level 2 entity, it will be level 2 entity, because in level 1 it is saying that exceeding 250. Okay. As far as borrowings is concerned, so the earlier limit of borrowing was very less, exceeding 1 crore but does not exceed 10 crore. Again, this limit has been increased manifold. So now this limit is exceeding 10 crore but does not exceeding 50 crore. So if an entity is having a borrowing at any time during the previous year is more than 10 crores but less than or up to 50 crores, in that case it will be classified as level 2 entities. So this turnover of 1 to 50 has been increased to 50 to 250 crores. Borrowings of 1 to 10 has been increased to 10 to 50 crores. Coming to level 3 entities. So earlier the level 3 entities are the entities which are not level 1, not level 2. So if an entity has a turnover of let's say 5 lakh rupees, or an entity has a borrowing of let's say 2 lakh rupees, in that case it will be level 3 entities because it was the last level. Okay. But now this level has been increased, and level 3 entities are those entities which have a turnover of more than 10 crores but up to 50 crores. Okay. And they have a borrowing of more than 2 crores and up to 10 crores. So if an entity has a turnover of more than 10 crores, of course, but up to 50 crores, and borrowings of more than 2 crores and of course up to 10 crores, in that case it has to be classified as level 3 entities. And the entities which are neither level 1, level 2, level 3 are considered as a level 4 entities. So level 4 entities are those entities which have a turnover of less than 10 crores and borrowings of less than 2 crores. So these limits have been increased, has been revised manifold, and which gives a great relaxation, great comfort to the auditors and accountants of these non-corporate entities as far as compliance is concerned. So coming to the applicability of accounting standard to non-company entities, as I have told you that on level 1 entities, all the accounting standards are applicable. On level 2 entities, 7 accounting standards are not applicable. 7 standards are not applicable. When I talk about level 3 entities, 9 standards are not applicable. When I talk about level 4 entities, 11 standards are not applicable. So coming to AS1, AS1 is a very basic standard which talks about disclosure of accounting policies. And this AS1 is applicable to all the entities, be it level 2, level 3, level 4. I'm not talking about level 1 because on the level 1, all the 27 accounting standards are applicable. When I talk about AS2, it is an inventory related standards. So this standard is also applicable to all the entities, either level 2, level 3, level 4. Coming to AS3, AS3 is a standard which talks about cash flow statement. And as an accountant or auditor, sometimes you are struggling with preparation of cash flow statement. Whether we need to prepare as per direct method, we need to prepare as per indirect method, how to prepare these cash flow statement, how to classify cash item, non-cash item. So which item would be operating, which item would be investing, which item would be financing. Okay. So that is why the cash flow statement has been given as an exemption to all these level 2, level 3 and level 4 entities, and this AS3 is not applicable to these set of entities. Coming to AS4, so AS4 talks about events occurring after balance sheet date. So of course, if you are preparing a balance sheet of 31st March and this balance sheet is getting signed or this balance sheet is getting adopted or approved on let's say 15th of September, then whatever events which is impacting your 31st March balance sheet has to be disclosed, and hence this AS4 is applicable to all the entities. Coming to AS5, AS5 is something which talks about the prior period items, which talks about accounting policies. So this standard is also applicable to all the entities. So I hope it is clear as of now. Coming to AS6, AS6 was on depreciation accounting, and this standard was deleted with effect from 1st April 2016. AS7 is on construction contracts. So if an entity has been engaged in the construction related activities, then this AS7 will be applicable to all the set of entities. Coming to AS9, if there is an entity, there will be a top line. And if there will be a top line, there will be a revenue. And if there is a revenue, there will be a revenue standard. And AS9 talks about revenue recognition, revenue. And hence this standard is applicable to all set of entities. Coming to AS10, So AS10 is on property, plant and equipment, which is a tangible asset, which is a fixed assets. So AS10 is applicable in its entirety to level 2 entities, but as far as level 3 entities are concerned or level 4 entities are concerned, some additional disclosures which is required to be given in level 1 and level 2 is not required to be given in level 3 and level 4 entities. So some disclosure exemption have been given here. Coming to AS11, the foreign exchange standard, this standard is completely applicable to level 2 entities and level 1 of course, but this standard is applicable to level 3 and level 4, but some disclosure exemption is given in this particular standard. Coming to AS12, it is related to government grants, and if the government has given any grant to any set of entities irrespective of its criteria, this standard will be applicable. Coming to AS13, which talks about investments accounting. So this standard is completely applicable to level 1, level 2, level 3, but there are some disclosure exemption which is given to the level 4 entities. For example, this AS13 says that some other disclosures are required to be given if it is required by some statute. But this kind of exemption has been given for level 4 entities. Coming to AS14, which is accounting for amalgamation standard. So accounting for amalgamation standard is applicable to level 1, level 2 and level 3 completely. But for level 4, the exemption have been given. So it is not applicable altogether. But if there is a transaction which is related to business combination, I will not use the word business combination because it is largely used in the Ind AS or IFRS scenario. If there is an acquisition kind of transaction, in that case this standard will be applicable. Otherwise this standard will not be applicable. Coming to AS15, which is an actuarial related standard. Although the name of the standard is not actuarial related standard, it is standard on employee benefits. So coming to the employee benefit standard, this standard is completely applicable to level 1 entities. But as far as level 2, level 3, level 4 is concerned, the standard has provided, or ICI has provided some exemptions relating to measurement criteria on the employee benefits to level 2, level 3 and level 4 entities. On AS16 borrowing cost, this standard is applicable to all the set of entities because if the entity has taken some borrowing for the purpose of acquisition, construction or acquisition, construction or production of a qualifying asset, in that case this borrowing cost treatment is applicable to all set of entities as per accounting standard 16. AS17 talks about segment reporting, and segment reporting is not required in case of level 2, level 3 and level 4 entities, and these set of disclosures, these set of standards are not applicable to these entities. AS18 related party disclosure. If there is a transaction of a partnership firm with the partner and for example the firm is providing a salary to the partner, it is a related party transaction, and this standard AS18 is applicable to level 1 and level 2, but it is not applicable to level 3 entities and level 4 entities. So which entities are level 3 entities? So we discussed level 3 entities are those entities which have a turnover of more than 10 crores but up to 50 crores. Earlier it was more than 1 up to 10, but now it is more than 10 up to 50. Okay. So if there is an entity which has a turnover of up to 50 crores or a borrowing up to 10 crores, this standard is not applicable. You are not required to identify what is a related party transaction and what should be the disclosures. Coming to the leases standard. So in the leases standard on which is AS19, so it is completely applicable to level 1, but it is applicable to, of course, if there are leases, the accounting for leases is required. And if the accounting for leases is required, then AS19 will be required. But as far as AS19 is concerned, some disclosure exemption is given to level 2, level 3 and level 4 entities. And these disclosure exemptions are largely related to gross investment in lease less unearned finance income in respect of new business added during the year. So these are some encouraged disclosures. These are some other disclosure. These are some more disclosures, and hence these disclosures exemption has been given to these set of entities. Coming to AS20 earnings per share, this standard is not applicable to level 2, level 3, level 4 entities. Coming to AS21 consolidation related standard, the standard talks about consolidated financial statement. So consolidation of an entity where there is a control. So AS21 is not applicable to level 2, level 3 and level 4 entities. But if these entities wants to do the consolidation, so it is not applicable altogether. But if the management wants to prepare the consolidated accounts, in that case, this standard has been required. This standard will be applied for preparing the consolidated financial statement. Coming to AS22, AS22 is something which talks about accounting for taxes on income. When I say accounting for taxes in income, so this standard talks about current taxes as well as deferred taxes. When I say current taxes and deferred taxes, the large part of the standard deal with the deferred tax accounting. And this standard is applicable because when there is an income, there are taxes. Okay. Even though if there are laws, still there are taxes. I am not saying it is payment of taxes. I am saying it could be a refund of taxes. Okay. So accounting will be required. So as far as AS22 is concerned, this standard will be applicable to level 1, level 2 and level 3 entities. But for level 4 entities, the deferred tax portion, which is a major part of the standard. So this AS22 current tax portion is only applicable to level 4 entities, and apart from current tax portion, the remaining part of the standard is not applicable to level 4 entities. A big relief for level 4 entities. Who are the level 4 entities? Level 4 entities are those entities which are neither level 1, level 2, level 3. And if I talk about the turnover is less than 10 crores. The borrowings are less than 2 crores. Sir, whether the limit is either or and, it is either or, it is not both. Okay. So coming to AS23, AS23 talks about associate consolidation. If you are having a significant influence in other entity, or if you are having an associate, in that case AS23 will be applicable, and it is applicable only to the large entities which are level 1. It is not applicable to level 2, level 3 and level 4 entities. But if the management wants to do the consolidation of associate, in that case the management needs to apply, the auditor needs to verify or audit the compliances from the perspective of AS23. Coming to AS24, discontinuing operations. So this standard is applicable to level 1 and level 2, but it is not applicable to level 3 and level 4 entities. AS25, interim financial reporting. If I talk about interim financial reporting, means less than a year reporting, or I can say that quarterly reporting, half yearly reporting. So this standard is not applicable to level 2, level 3, level 4. But sir, if management wants to do the quarterly reporting, then what can I do? In that case, this standard will be applied for quarterly reporting. AS26, intangible assets. So this AS26, of course, in an organization, if there is an intangible asset, if the entity has acquired a brand, acquired a, let's say, trademark, patent, copyright, tally software, ERP software, in that case, this intangible asset will be applicable. So of course, this standard is applicable in its entirety to level 1, level 2 and level 3 entities. But it is also applicable to level 4 entities with some disclosure exemption. For example, when you prepare the intangible asset schedule, so this carrying the opening balance to closing balance reconciliation is required. So in that case, you are not required to disclose the impairment charge during the year or impairment reversal during the year. So this kind of exemption is given there. Or if there are intangible assets which are still active, still in use, but the net block is 0, or these intangible assets has already been amortized. So such disclosure is not required in case of level 4 entities. So this kind of disclosure exemption is given there. Coming to AS27, which talks about consolidation of joint venture. Again, this AS27 is not applicable to level 2, level 3 and level 4 entities. But of course, if the management wants to do the consolidation of joint venture, this standard will be applicable. AS28, impairment related standard. This standard is completely applicable to level 1. But as far as level 2, level 3 and level 4 is concerned, this standard will be applicable, because if there is an asset, you need to check the recoverable value as well from the perspective of true and fair view, or true and fair picture of the asset side of the balance sheet. And hence AS28 is important and it is applicable. But as far as micro, small and medium entities are concerned, there are some disclosure exemption given in the standard. And for the micro entities, because these are very small entities, very immaterial entities. So for these entities, Institute has given an additional relief by making this standard not applicable to level 4 entities. AS29, which talks about provisions, contingent liability and contingent assets. this standard is completely applicable to level 1 entities, but for level 2, level 3 and level 4 entities, there is a disclosure exemption which is given in this particular standard. So this was about applicability of accounting standard to non-corporate entities, and which is as per the ICAI guidelines and ICAI announcement dated 31st March 2021. So I have covered these part while discussing this line by line applicability of accounting standard. So thank you very much. Thanks everyone for joining this session.
Thank you so much, Alok ji. Thanks for giving such a detailed standard by standard clarity on applicability of these accounting standards in just 30 minutes. We understand the time was very short, but you covered very in detail every standard by standard and what are the changes compared to the earlier position, how from 3 levels to this journey to 4 levels and how it will be applicable. Thank you so much for your session. And for participants' information, I can just mention that the announcement is hosted on ICAI website. So members are requested to log in and have a look at the announcement, because certain general questions like if level there is change in level of the entity, or whether all the exemptions can be taken together or few exemptions can be taken. So all those points are covered in at the end of the announcement, which the readers can take clarity from the announcement. So now we can move on to this next session, basically, which is covering accounting standard 10 and accounting standard 26, property, plant and equipment and intangible assets. So I'll request CA Achal Jain ji to take the next session. I can briefly introduce CA Achal Jain, who is a regular faculty for the Institute on various programs on accounting standards, Indian accounting standards and assurance standards related topics. He is currently into practice with specialization in assurance and advisory services. He has more than 15 years of experience in accounting, auditing and financial reporting. He has assisted various Indian and global companies in transitioning to Ind AS, IFRS and other complex accounting related guidance such as US GAAP. Then he has rich experience of providing trainings on Ind AS, IFRS and US GAAP. So I'll just hand over the session to Achal Jain ji. Thank you, sir. Over to you.
Thank you, Parminder ji, and good afternoon to all of you. So today we plan to discuss a couple of topics. One is on accounting standard number 10 and the other one is on accounting standard 26. So I'll just start with accounting standard 10, that is on property, plant and equipment. I'll just quickly share this presentation. So talking about AS 10, which is dealing with the requirements related to property, plant and equipment. First of all, I'll just give you a brief background about this standard. We are all familiar with the term fixed assets. Fixed assets is all about plant and machinery, building and all of these assets, and which is very, very commonly applied in respect of the financial statements of any entity. That's why this standard is really relevant to all. The other aspect of this standard is that now this term fixed asset has been changed and we don't call fixed assets as fixed assets any longer. This is now being termed as property, plant and equipment. Other aspect related to the standard is about the understanding in terms of its applicability to the non-corporate entities, is about that this standard got changed few years back. And this got aligned with the requirements related to Ind AS. And when we talk about this alignment with the Ind AS, we are just talking about effectively all the requirements which you see in case of Ind AS have got sort of replicated in this standard also. Secondly, talking about this accounting standard 10, when we consider its applicability for the non-corporate entities, as you have just understood that this standard is effectively applicable to all the entities in its entirety except for certain disclosure exemptions, which is again applicable only for level 3 and level 4. And that disclosure is again a very small disclosure. So I would say this standard in its entirety is very, very important for non-corporate entities also. The way this standard is currently applied, as we generally see in respect of non-corporate entities, is on the basis of the old accounting standards. So prior to this AS10 revised, there was a separate accounting standard under Indian GAAP, which was dealing with the requirements related to depreciation, that was AS6. And there was a separate accounting standard AS10, which used to deal with the requirements of fixed assets. But now, in relation to Indian GAAP also and in relation to non-corporate entities that we are currently looking at, we have one accounting standard. So we can say that both of these standards are no longer applicable, and now we have only one accounting standard which deals with the various requirements related to property, plant and equipment, or we can say fixed assets as well as depreciation. So I'll just quickly take you through some of the requirements related to PPE in terms of its recognition, measurement and the definition, and we'll also try to see if there is anything which is significantly changing as compared to what we have been doing practically in relation to most of our clients. So talking about PPE, let us first of all understand the definition of PPE. Now this is very, very important to understand. What is PPE? PPE means an asset which fulfills two criteria. What are those two criteria? That it should be a tangible asset which is held for use in production or supply of goods or services, or for rental, or for administrative purposes. For example, if we talk about plant and machinery, that is used for production or supply of goods. If we talk about furniture and fixture, if we talk about building, that means the office building, that is nothing but the administrative use in respect of this tangible asset. So this is first part of the definition. The other part, and which is the most important part of the definition, is about its expectation to be used for more than 12 months. Now, any tangible asset which is expected to be used for more than 12 months will become PPE as per this standard. Means, whenever we are looking at any tangible asset, if that has expected useful life of more than 1 year, only then it will become PPE, otherwise not. Now this is something which is not commonly applied, even if we look at practically in most of the cases when we prepare the financial statements or when we do this day-to-day accounting. I can see that this is one area which is generally missing, so that's why I'm just focusing on this aspect as well, and this is how we now need to consider the definition of PPE. Now moving further, in relation to this PPE, let us talk about the aspects related to the recognition. Now, like any other asset, the recognition criteria for PPE will also remain the same. Now, for an asset, what is the recognition criteria? First, there should be future economic benefits which are expected out of it. And second, its cost can be reliably measured. Now the same criteria for recognition applies to PP also. It's like any other asset. So whenever we talk about any asset, this recognition criteria has to be understood. So that's why for PP also again we'll have to consider these two criteria whenever we look at its recognition. Moving further on to the measurement part. Now in relation to PPE, when it comes to the measurement, we can say we are now looking at the amount at which PP is required to be recorded. In this relation, standard talks about certain costs, and I'll just break this cost into two parts. First, that is the purchase price. or we can say the price which is forming part of the purchase price. So it's about the purchase cost, or it is about the non-refundable taxes or duties which are required to be included in the cost of the PPE. And any refundable duties or taxes will not form part of cost of PPE. So this is an area which remains same, which is not changing, okay, which is largely considered also by all of us. Plus, if there are any trade discounts which had been offered by the vendor to us, vendor means when we go and purchase an item of PPE, or if we have received any sort of rebates in relation to that purchase of item of PPE, those discounts and rebates are required to be excluded from the cost. That is how we look at the cost part in relation to the purchase. So we can say this is something which is related to the purchase cost. Secondly, in relation to this purchase cost, we also need to consider certain directly attributable costs. Now let's understand what are these directly attributable costs. Directly attributable cost means any cost which is related to the acquisition of an item of PPE till the time PPE is not ready for use. For example, if we go and buy a machinery, so if there is any cost which has been incurred for its installation, if there is any cost which has been incurred till the time this machine doesn't become ready for use, all of these costs are what? These are the add-on costs. But these are directly attributable to this machinery and in relation to this aspect that this machinery becomes ready for use. So all such costs are also required to be added to the cost of the PPE. Let's take another example. Let's suppose if we are constructing a building. So now in relation to construction of a building, one is about the procurement of the material, cement, etc. Plus will also be required to involve labor. So that means the manpower, the employees. Will also be required to engage consultants who will guide us in terms of this construction. And will also be required to use certain machineries which may be purchased by us for the construction of this building, or which may be taken on hire for construction of this building. Now all of these costs, whether it is about manpower, whether it is about consultant cost, or whether it is about depreciation of those equipments which are used for construction of building, or rentals of those equipments which are used for construction of building, all these costs are again what? These are the directly attributable costs, which are also required to be considered for the purposes of this measurement of the PPE. So that's why whenever it comes to the PPE, we need to consider the purchase cost as well as all the directly attributable costs. Now herein, again, one aspect which is generally looked at by us is up to which point of time we should keep adding the cost to the PPE. Should it be the stage when the PPE becomes ready for use, or should it be the stage that is when the PPE is being used? That means PPE is put to use. Now in this case, it's very, very important to understand that the moment an item of PPE becomes ready for use, irrespective of the fact that it is getting used or not, because it doesn't matter to us. If this becomes ready for use, only up to that stage, any cost which is directly attributable to that item of PPE will be capitalized. And any other cost or any cost which is after this stage will not be added to the cost of the PPE. Further onto this, there are also certain costs which are required to be incurred by an entity in respect of dismantling, or in respect of restoration, or in respect of decommissioning, which are not incurred today but which will be incurred in future. Those costs will also form part of PPE now. Those costs are also required to be considered as one of the cost component of PPE, because this is again something which even though has not been incurred today, but which is going to arise in future because of certain events which have taken place, or because this item has been procured in the current year itself. So that's why this is again a third component which is always required to be considered, and which is required to be considered as a part of the cost of the PPE. Now, along with this, I'll also touch upon one more aspect related to PPE. Now, when it comes to PPE, standard says that the way the PPE is required to be capitalized and then depreciated will be on the basis of the components. This is also called as componentization. Now let's quickly try to understand about this componentization. What do we mean by componentization? Componentization means that whenever we acquire an item of PPE, that item of PPE should be further segregated into various components. And those components should be capitalized separately and should also be depreciated separately. So let's take an example of an aircraft. Let's suppose an entity has acquired an aircraft. Now one way is to capitalize this aircraft as a single item of PPE and also depreciate it over its useful life, which let's suppose is 15 years in this case. The other approach is wherein instead of capitalizing this aircraft as a single line item, we break it into three components. What are those three components? Say, engine of the aircraft is one component, wheels of the aircraft second component, and third is the remaining body. And all these three components are not depreciated over 15 years. Instead, they will be depreciated over their useful lives, over their own useful lives. So for example, let's suppose engine has got useful life of 7 years. So engine will be depreciated over 7 years. Wheels have a useful life of say 4 years. So they will be depreciated over 4 years. And the remaining body, which let's suppose has a life of 15 years, that will be depreciated over 15 years. This concept is called as componentization. And this concept of componentization requires certain factors to be considered by us. First, we are not required to consider each and every component when it comes to the component. We will only consider the components which are significant. Means materiality has to be considered. Second, we need to consider only those components which have got different useful lives. Third, we only need to consider the components which are replaceable. Because let's suppose if the components are not replaceable, they don't have any different useful life as compared to other components. So will that make any difference in terms of depreciating them over their own useful lives? No. That will only make a difference when they are replaceable and they will have their life which is different from other components. So that's why whenever it comes to the componentization, we always need to consider the fact that depreciation is something which is a perspective which has to be kept in mind, plus these three factors, that they have to be significant because we are not going to consider each and every component. Second, we need to consider whether they have different useful lives. And third, we need to consider whether they are replaceable or not. And accordingly, those are required to be capitalized and depreciated. Alright. Now, talking about this componentization approach, as we just discussed that this componentization has more to do with the depreciation, because this will largely impact the depreciation as compared to anything else. So that's why it's very, very important to understand this with the perspective of depreciation. So I'll just move on to this aspect related to depreciation now. As per the standard, every item of PPE is required to be depreciated over its useful life. And this useful life is the expected useful life. Means every entity will estimate the useful lives of various items of PPE. And all those items of PPE will be depreciated over those useful lives. Just 1 minute, and let me just move on to that depreciation. Alright. Now, in relation to this depreciation, generally there's a thought that should we really consider the useful lives which are somewhere available, or is there any criteria which is required to be considered for the useful life? No. So the standard says that the life is the one which is estimated by the management, and this life should be the expected useful life. Means the management is expecting this useful life in relation to that particular category of property, plant and equipment. And over that, this is required to be depreciated. However, this expected useful life is also required to be reassessed by the management. Means this is required to be reviewed by the management at every year. Okay, and when it comes to the review, again, it's not something which is a mandate to review each and every line item. Here again, management is required to consider certain factors on the basis of which useful life may get changed, and if that gets changed, then the useful life is also required to be changed. And when this change will happen prospectively. Let's understand with the help of an example. Say an entity acquired a machine and estimated that the life of this machine will be 10 years. After 3 years, management estimated that because of the change in technology, now because there's a change in technology, it's not something that they are reviewing each and every item every year. Because there's a change in technology, so they reassessed and they found that initially which they estimated in respect of this machine, the life is not going to be 10 years. Instead, the life will now get limited to 6 years. So earlier, what were the management doing? They were depreciating this machine over a period of 10 years. And now what will they be required to do? They will have to change their expected useful life of this machinery. Secondly, this change will happen prospectively. So now this machine will have to be depreciated over next, or you can say over the balance useful life of the asset, instead of the original useful life of 10 years. So we can now say that the life of this machine on a totality basis will be only 6 years. Now, when it comes to the depreciation, another factor which is required to be considered happens to be the residual value. We all understand that PPE items will generally have some residual value. And generally, if you look at the items of PPE, we consider residual value equivalent to 5%. In certain cases, we also consider it as 0% or 10%, but generally the practices which you see, they consider 5% as the residual value. Again, this is not something which is a norm. Standard again requires management to estimate the residual value. And this residual value, even though this is estimated at the time of acquisition of the PPE, is also required to be reassessed. This is also required to be reviewed at every reporting date. Similar to what we do in case of useful life of PPE. And if there is any change in respect of this residual value, that is also required to be changed. But similar to what we do in case of useful life, this change will also happen prospectively. Now, talking about depreciation, the third perspective which we need to consider over here happens to be the depreciation method. Now, depreciation methods are very commonly known to us. We can talk about straight line method of depreciation, which is permissible. We can talk about written down value method of depreciation, which is again permissible. We can also look at this third method, which is based on units of production, wherein we don't consider the life of the asset, instead we consider the number of units which are produced on the basis of the usage of this asset. So that can also become the basis. Now here again, standard is not specifying which method is required to be used. This is something which the management needs to assess, looking at the type of asset which is being used, as to which method will be the best for the usage in terms of the depreciation of the item of PP, and accordingly the depreciation should take place. Next aspect in relation to this depreciation comes to the componentization only, as we have just discussed, that whenever it comes to the depreciation of an item of PPE, what we need to consider is, we always need to consider the fact that the components which are significant, which are replaceable, which have got different useful lives, need to be depreciated on the basis of their own useful lives, means their independent useful life, means over the useful life of the component and not really the full item of that PPE. And that is how depreciation is required to be considered. Further on to this standard, when it comes to the subsequent measurement part, this standard gives us two options in relation to the measurement of the PP. Let us just quickly get on to those two models also. The first model is cost model, which we generally see, and practically we see that in most of the cases, cost model is considered by the entities in terms of measurement of an item of PP. What do you mean by cost method? Cost model means PP item is acquired and measured at its original cost. Then it is further depreciated. If there is any impairment in any period or in any year, that is charged on that, and the balance amount is there. This is called as cost method or the cost model, wherein we go with the original cost or the gross amount to which we charge depreciation year in a year, or we charge impairment if there is any, and then we get the net block. Now this is first model which is available for us in terms of the measurement. This standard also permits another model in respect of valuation or in respect of measurement of PP, which is called as revaluation model. Now in relation to revaluation model, as against the cost model, what is required to be done? Then the item of PPE is required to be revalued at every reporting date. Say for example, an entity has got three types of PP: building, land, plant and machinery. And the entity has chosen revaluation model in respect of land. So what will this entity do? Now instead of keeping this land at cost, this entity will remeasure the land. And this remeasurement will be at the revaluation amount of this land. Now here again, this revaluation is not something which the entities do on an annual basis, though it is always suggested to do this on an annual basis, but a cost constraint will also be involved. So that's why a frequency is picked up by the entities. Generally, we see that entities pick up a frequency of 2 to 3 years in respect of considering this revaluation. But this revaluation model is also available. The only thing is that when it comes to the revaluation model or when it comes to the cost model, we always need to consider some of these models on the basis of the categories of the PPE. So means to one category of the PPE, one model needs to be applied, and to other category, other model needs to be applied. Within a category, all the items of PPE. So for example, if we talk about plant and machinery, so this is one category. So within this one category, all the items of plant and machinery need to be measured at cost if the cost model has been opted for plant and machinery. Yeah. Now moving further on to the disclosure requirements, as we understand that there are certain exemptions which are available in respect of disclosure requirements of PPE, but largely the disclosures which we see when it comes to the movement of the PPE in terms of presenting it in the financial statements means starting with the gross block, then disclosing the accumulated depreciation or the depreciation for the year. Then it comes to the net block, whether it is about the disclosure in relation to depreciation method, disclosure in relation to useful life, disclosure in relation to residual values, if there are any changes in this. Excuse me. All of those disclosures are important, and all of these things happen to be similar sort of they happen to have similar sort of applicability in respect of non-corporate entities as well. Yeah. So with this, we are done in respect of our discussion on PPE. So what I can do now is I can just move on to the next topic, that is about AS 26. I'll just take 1 minute. Okay, so moving on to the next topic, that is about AS 26. AS 26, once again, when it comes to the applicability of the standard in terms of the non-corporate entities, as we have seen, there are again not much of a difference, and only in respect of level 4 entities, certain disclosure requirements have been exempt. So once again, this standard happens to be an important standard, whether it comes to its recognition, whether it comes to its measurement, or whether it comes to its disclosure requirements also. And let's also try to understand the rationale when it comes to PPE or when it comes to intangible assets. We all understand that these are very commonly used standard, particularly PPE, very commonly. There is no entity which will not have any tangible asset in its financial statements. And these days, you will again not find much of the entities will not have, which are not having any intangible assets in their financial statements. So in terms of their usability, in terms of their relevance, these are very relevant standards. So that's why much of the exemptions are not seen in case of AS 26 also. So let us quickly understand about the meaning of an intangible asset. Now this standard is quite important in terms of its understanding, because to a certain extent bit of technicality is also involved in this. So that's why we'll just try to focus on some of aspects in this standard which are different from PPE, because what you'll also see in this standard is that there are a lot of similarities in between PPE and intangible assets. We'll discuss about those similarities also. So let us move on to definition of intangible assets. What is an intangible asset? An intangible asset means an asset which is intangible in nature. Now what do you mean by intangible in nature? Intangible means something which is not having any physical substance. So for example, if we talk about software, is the software tangible in nature? No. We can always say that software is always embedded somewhere. It could be any hard disk, it could be any pen drive, or it could be any disk wherein the software is embedded. But in relation to this tangible part wherein this software is embedded, can we really say that the worth of that tangible part is significant as compared to the worth of the software? The answer is generally no. Answer is generally no. That's why whenever we talk about any intangible asset, even though we will find that some of these intangible assets will be embedded with some tangible asset, still we will ignore that part of tangible asset because that will be of a very, very small amount. That will be a very, very insignificant. That will be a minuscule portion. So that's why that is something which is required to be ignored by us. Now, coming back to the definition of intangible asset, we discussed that this is something which is not having any physical substance. Secondly, this should be something which is controllable. This is something which is controllable and which is transferable. Now, what do you mean by transferable? Something which can be sold out, something which can be leased out, something through which economic benefits which are attached to this asset can be generated by the entity. If we look at some examples for this, software is one, patents, trademarks, brands, all of these are what? All of these are nothing but the intangible assets which are not having any physical substance, and the one which we can very well say are controllable, which are transferable also. So that's why we are able to consider them when it comes to the capitalization of those intangible assets. Now over here, one aspect which is required to be considered by us happens to be some of the assets which even though are intangible, but those are internally generated. Let's try to understand about this. Say for example, an entity has been running for last 20 years. So an entity has been into some business and they have been continuing this business, and over the period, because this entity has been in this business for so much time, and because they have this reputation in the market, they have some customers which are attached to them over a period. So that's why we can very well say that some sort of brand or some sort of reputation or goodwill has been generated, which is attached to this business. There's no doubt about it. But a question arises that when it comes to this name, when it comes to this brand, or when it comes to this goodwill, which has got generated, which this entity has been able to build for itself over a period of time, is this required to be capitalized, or can we really capitalize this? The answer is no. The answer is no. Because if you look at this type of intangible asset, or if you look at this type of goodwill or this type of asset, even though this is having some sort of economic benefits which are being provided to this entity, still these are not the ones which are transferable. We cannot say that this is something which is transferable. So that's why when it comes to the intangible assets, we generally find that the internally generated intangible assets are not capitalized. Internally generated intangible assets are not capitalized. Now moving further on to the recognition part. Now in relation to intangible assets, when it comes to the recognition, here again the recognition criteria will remain the same. As we discussed that recognition criteria for all the assets is same. So because intangible asset is again an asset, so that's why for intangible asset, what is going to be the recognition criteria? First, there must be some future economic benefits which are expected out of this asset. Second, its cost can be measured reliably. Its cost can be measured reliably. Moving further on to the measurement part. Now measurement part in relation to intangible asset, to a certain extent we can say is similar to what we see in case of PPOs. As we saw that recognition criteria for PP, intangible asset same. Why? Because both of them being asset. Now when it comes to the measurement part, At the time of initial recognition, PP is measured at cost, and subsequently we have two models available. What are those two models? Cost model and revaluation model. Similarly, when it comes to the intangible assets, at the time of initial recognition, how do we measure it? Again, we measure it at cost. And in relation to this cost, here again, we have got some cost components. What are those cost components? Let's understand those cost components. We just need to recollect the cost components which we discussed in case of PPE. First is the purchase cost, means the purchase price for any intangible asset which has been paid, to which any sort of non-refundable taxes, non-refundable duties are required to be added. If there are any refundable taxes, refundable duties, those will not be added, means those are excluded from the cost. Here again, if there are any discounts which have been offered by the vendor at the time of acquisition of an intangible, if there are any rebates which have been offered by the vendors at the time of acquisition of any intangible assets, those are required to be deducted from the cost of the intangible. Something similar to what we see in case of measurement of PP. Next component is about the directly attributable cost. Now this is again something similar to what we say in case of PPE. What are directly attributable costs? Say for example, if we are generating any in-house intangible asset, means we are working on an intangible asset, so there could be certain costs which may be involved in respect of the research team, in respect of the development team. So all of those employees who are working on the development of that intangible asset, that cost is nothing but directly attributable to the intangible asset which is getting created. Now, here again, some consultants, some professionals may be engaged by the entity in relation to development of that intangible asset. Now, those consultant charges, those professional fees are incurred in relation to what? Incurred in relation to creation of that intangible asset. So that's why here again, what do we need to do? We need to add these costs to the cost of the intangible asset. Here again, let's suppose if there is any premises wherein this intangible asset is getting generated, a team which is sitting and working on this entire part, they are sitting in a premises. Now this premises could be taken on lease or this could be owned by the entity. If this is taken on lease, then the lease payments are being made. If this is owned by the entity, then the premises is getting depreciated. So either of them which is incurred by the entity, means lease or the depreciation, whatever be the case, that will again be considered to be the directly attributable cost incurred in relation to that intangible asset. So all of these cost components are required to be considered and intangible asset is not ready for use. Same principle is required to be considered in case of PP. Means till the time it is not ready for use, all the cost components will keep getting added to the cost of the intangible asset. Now, again over here we need to bifurcate whether the intangible asset has been put to use or whether the intangible asset is ready for use. Similar to what we see in case of PPE, we'll consider whether the intangible asset is ready for use and will ignore this aspect that whether the intangible asset is put to use or not. So that is not relevant for us. We only need to consider this factor. We only need to consider this stage. And any cost, even though if we keep incurring any cost after the stage when the intangible asset has become ready for use, is required to be ignored. Ignored means that will not get capitalized along with the cost of the intangible. That will simply be charged off. That will not get added to the cost of the intangible asset. Now moving further, in relation to intangible asset, when it comes to their generation. Now this is something which is also, I would say, a different part of the standard as compared to PP, and slightly technical aspect in relation to intangible assets. So that's why this is something which is very, very important to understand. When it comes to certain intangible assets over which an entity works in terms of their generation, standard requires certain considerations to be given in terms of the phase we are into or stage we are into. And these stages or phases are called as research phase and development phase. Standard says that if the entity is incurring any cost during the research phase, means during the phase when the research for an intangible asset is going on, but the development has not yet started, then any such cost is required to be charged to the statement of P&L. Means that will straight away go to P&L. That will not be capitalized. And if the development phase has started in respect of an intangible asset, means the research phase is over and the development phase has started in respect of an intangible asset, then such cost will not be charged to P&L. That will be capitalized. That will be capitalized till the time intangible asset is not ready for use. Now, assessment of these two stages is very, very important. This is very, very judgmental. And I'm sure many of you would have dealt with this. This happens to be at times one of the most challenging area in terms of the accounting when it comes to the audit side, in terms of auditing the aspect whether this stage has really changed from research phase to development phase, or how should this stage be really assessed by us. Now let's also try to understand what is the impact of this. Any expenditure which is incurred during the research phase will keep going to P&L, and any expenditure which is incurred during the development phase will only be capitalized, means that will not hit the P&L. So that means we can very well see that just by manipulating these two stages, or if the assessment of these two stages is not done correctly, then there could be an impact on the P&L of the P&L of the entity. So that's why assessment of the stage is very, very important, is very, very critical for an entity. So let's understand what is this research phase. Research phase, we can say in a way, in very, very simple terms, is a stage when an entity is only looking for a product, is only looking for something, and over which there is no clarity whether the entity will succeed or not in terms of its generation or in terms of its creation. Entity is not sure in this stage as to what will be the outcome. Means some sort of experiment is going on during this stage. During this stage, forget about the future economic benefits, forget about the feasibility of this project in terms of the commercial viability of this project. An entity is not really clear whether the product will get developed or not. Such stage is called as research phase. And let's try to compare this research phase with the development phase. Now, what is this development phase? Development phase is the phase wherein an entity can demonstrate all of these conditions. Technical feasibility of completing the intangible asset is there so that it will be available for use or it will be available for sale. The intention to complete is there, to use it or sell it is there. Entity is also capable of using it, capable of selling it. The future economic benefits will be there. Means the project or the product which will get developed through this intangible asset will also be something which will be technically feasible, commercially viable, because that is again very, very important consideration for an entity. Plus, an entity will also have the ability to measure the expenditure during this stage. Now let's look at some examples to differentiate between these two. During the research phase, what is it that the entity is doing? Entity is kind of obtaining a new knowledge because they are just moving towards attaining this new knowledge. The search for, evaluation or final selection of this knowledge is going on. The search for alternatives is going on. Yeah, so we can say that nothing is finalized in this stage. Entity is just looking around, just trying to think of as to what can really be developed, but nothing has been established or finalized as yet. But when it comes to the development phase, let's look at some examples. What is it that the entity has achieved? Design, construction, testing of pre-production, or you can say prototypes are available to an entity. New technology is available with the entity. Means entity has crossed a stage wherein the experiment was going on. As we discussed that a careful evaluation of both these stages is very, very important. Because to draw a line as to when the research phase ends and when the development phase starts is very important, because this will have an impact on the P&L of the entity. But this is very, very important. Why? Because any expenditure, even if it is taken to, let's suppose, research phase and thereby taken to P&L, cannot be recouped. Means, let's suppose if there is a stage or if it happens that an entity considered certain expenditure as if this was incurred during a research phase and charged it to P&L. And later on entity realized that this stage was not really the research phase, or the amount which the entity took to the P&L by considering as if it was the research phase was not really the research phase, and that's why entity now wants to bring it back to the development phase and capitalize it. That is not possible. So the standard says something which has gone to P&L because the entity considered that to be a part of the research phase cannot be recouped later. This will continue to stay in P&L forever. Yeah, but this becomes the basis for an entity to consider as to which all expenditure will form part of research phase and which all expenditure will form part of development phase. Moving further, in relation to its subsequent measurement, now similar to what we do in case of PPE, we are required to amortize the intangible asset. Now, intangible asset is required to be amortized over its expected useful life. This is again similar to what we see in case of PPE. In case of PPE, we call it as depreciation. In case of intangible assets, we call it as amortization. For the purposes of amortization, we consider expected useful life, and the standard also talks about residual value. But generally, we will not find residual value in case of generally we will not find, because let's think about an intangible asset. It will be practically very difficult to demonstrate that any intangible asset will have some residual value, even if we talk about 1% or 2%. So just why generally what you find is that residual value in case of intangible assets happen to be 0. But here again, similar to what we do in case of depreciation, we are required to reassess, we are required to review this expected useful life year on year. As regards the amortization, here again the amortization should be based on the pattern in which the economic benefits are consumed by the entity. And here again, practically what you see is that in most of the cases, straight line method of amortization is used by the entities. Generally, you will see this method being used by the entities in most of the cases. Now, one aspect which we discussed in case of PPE was about the componentization in relation to the depreciation, but that aspect is not there in case of intangible asset, because there's no really any relevance of componentization in this case, because this is effectively a single piece only. Now moving further, in relation to the disclosures, as we discussed, there are only few disclosures which are exempt for an entity which is level 4 when it comes to AS 26 for non-corporate entities. Otherwise, largely what we see that this standard is applicable to all the entities level 1, 2, 3, 4 in its entirety largely. But let's talk about its disclosures broadly. One is about its movement in terms of the block, in terms of accumulated amortization, and then the block, the useful life, the amortization methods. All of these things similar to what we see for PPE is also required to be disclosed in this case. So this is it that we had on intangible assets also. So thanks to all of you for your time, and now I'm just passing on to Parminder ji to take forward.
Yeah, thank you, Achalji. Thank you so much for such a detailed presentation, for covering all the aspects of both the standards, that is PPE and intangible assets. And you have very rightly pointed out that although these are old standards, but these are very much relevant and are being used by non-corporate entities, because almost all the entities have at least PPE. So these are very much relevant standards. So only one point, we have got a few questions, but one is basically is asked in context of PPE. Although that is related to borrowing cost, but we can address here also. So one participant is asking that a company has purchased a flat for official purposes from a builder. The possession of the flat was taken on 31st August, and then there was some furnishing work was done by the contractor, so which was completed on 31st December. So whether the interest for the period from 1st September to 31st December can be capitalized as a part of the cost of that flat.
See, when it comes to the finishing of this office building or this office premises, I would say that finishing happens to be one of the important item for considering this office premises to become ready for use. Up to 31st of August, because this finishing was not completed, so that's why the office premises was not ready for use, and that's why the interest cost or any sort of expenditure which they would have incurred up to 31st December when this office premises became ready for use can be capitalized.
Yeah. Thank you so much, Achalji, for your clarification on the question. So, so that was the one question related to PPE.
Sure.
Thanks a lot for your time and
Thank you
for your session so much. So now we can move on to our next session on Accounting Standard 28, Impairment of Assets. So I'll request CA Praveen Kumarji to take session on this standard. CA Praveen Kumarji is a senior partner and national head of assurance division of a leading firm of chartered accountants. He has post-qualification experience of more than 28 years. He had been a member of NACAS earlier and Accounting Standards Board, and he is also a member in various other committees or boards of the institute. Apart from taking sessions on various technical topics at various forums, he had also presented various papers at the international institutions. So I'll just request Praveenji to take the session. Over to you, sir.
Thank you so much, Parvinderji. Thank you very much for giving me this opportunity to share my thoughts on this important topic. And my presentation will be for half an hour, and I'll be sharing my slides with all of you. So if you allow me sharing screen, right? So I will just share the screen. Can you see my slides,
Yes, sir.
Parvinderji?
Yes, sir. We can see.
Okay, thank you very much. Before we begin the presentation or discussion, I would like to put that disclaimer in order. So whatever is being shared here is my personal, very personal views, and it is not in any way should be taken as view of the institute or the board. It is my own understanding of the standard. So in case somebody wants to take a call or a view on the basis of this presentation, I would recommend that one must go through the literature and the guidance which has been given by the institute in various standards, and also apply the professional judgment in their own capacity. So this is a very basic thought which I wanted to share with you. So frankly, impairment testing is one of the burning topic as on date, where the regulators are tightening the screws, and the auditors are also looking at financial statements from a very microscopic angle. So impairment testing is one standard which comes into play very frequently in most of the audits where the companies are large. So the summary of the presentation which I am going to do is, so I'll be sharing with you the objectives of this standard. I'll try to discuss, the scope and the areas which are not part of this particular standards, the areas like inventory and all which are out of the scope of this standard. Then I will discuss what is impairment, and we'll spend some time on understanding the definition of impairment and what exactly it means as per the accounting language. How to find recoverable value, so impairment is generally a difference between the recoverable value and the carrying value. We'll try to understand how this value is measured and how it has to be recognized in the books of accounts of any entity. So we will also understand what are the indicators when this impairment testing is required, and if there is a loss of some kind of loss due to impairment, how one should recognize and how the measurement is done for the impairment loss. There is a concept which we will discuss very briefly about cash generating unit, because impairment testing has to be done on the unit as a whole, which is treated as cash generated unit. And we will also share a case study through which we will try and understand the concept that, if there are various activities which are going on, and if those activities are interconnected, the company or the entity is not in a position to carve out one entity, then how the entities or how the activities as a whole need to be taken as one cash generating units. And this will play, when you are doing accounting of an entity, or you are doing an audit of an entity, you need to understand this concept of cash generating unit, on which we will throw some light. In case impairment testing has been done, impairment loss has been booked, and in future, those indicators are showing that, there is a requirement of reversal of impairment testing. So in which all circumstances that has to be done, and, what kind of disclosures are required to be made. Because in any case, as you read from the framework of accounting standard, it is very, very critical to make disclosures so that the users of financial statement should be able to get answers to their questions. So as you can read in the framework, there are various characteristics, and those characteristics of financial statements need to be adhered to. They need to be, so these financial statements need to be understood by any user. User can be internal, user can be external. But basically, the requirement of the framework is that all the details, whether, impairment testing was done, whether impairment loss was booked, whether impairment loss which was booked earlier has been reversed, why it was done, and what are the circumstances, and what is the stand which the view which company has taken, and how the financial statements have been prepared keeping these areas in mind. Those all need to be disclosed. And as accounting standard number 1 also says, that all those information need to be disclosed. So we will see what all disclosures are required in case of application of this accounting standard, which is accounting standard number 28, impairment of testing. So this was a very brief outline of the discussion which we are going to have. Frankly speaking, it is very, very difficult in half an hour or 20 minutes to summarize a standard and understand the nuances of that standard in greater detail. But somehow we have limited time, and we need to use the time which we have. So what I will do is I'll go on a macro level. I'll give you an overview of the understanding of this particular standard. So here is the slide, talks about the objectives. You can read the slide. But basic idea is that we do our accounting, which is, the concept of accounting is accrual system of accounting. And we need to, book the losses in the beginning whenever they are happening, or whenever there are enough indication, but revenue has to be booked when it is certain. So that is the conceptual understanding of our accounting framework. So basically, we need to ensure that, when an entity is preparing their financial statements, they are carrying the value of asset, which is not more than the recoverable amount. So the recoverable amount should not be, they should, so basically we need to be conservative. In case there are indicators, which we will discuss later on, we will need to carry out impairment testing, and impairment loss has to be recognized in the financial statement in the same year. In case the situation improves and those indicators are not there in future, or there are reverse indicators, we will need to ensure that impairment loss is reversed. So there is if you look at the words which have been used, look closely at those words which have been used in this standard. The word which has been used is may. So impairment loss may be reversed in certain circumstances. So ultimately, there is a subjectivity involved. So in case there are certain circumstances, the organization or the entity may decide to reverse the impairment loss. So and of course, whenever you are your entity is having an impairment testing and impairment loss is being booked, or impairment loss is to be reversed or is being reversed, disclosures are required to be done in the financial statements. So that's the overall objective of this accounting standard 28. As indicated earlier, I state that there are certain assets which will be out of purview of this AS 28. So, if you talk about inventories, they are being dealt with in accounting standard number 2. So impairment testing related standard, it does not deal with inventories. So you need to keep the inventories out of this standard. Then assets of construction contracts, they are being dealt with in the accounting standard number 7. So they will also be out of the scope of this particular standard. Then you talk about investments. Financial assets which are included in accounting for investment related standard, which is accounting standard number 13, they are also excluded from the purview of this particular standard. Deferred tax assets are being dealt with according to accounting standard number 22. So when we talk about impairment testing and standard on impairment testing, then we will exclude that as well. So AS2 talks about inventories, AS7 talks about assets of construction contracts, AS13 talks about financial assets or the investments which are there, and then AS22 talks about the deferred tax. So these assets are outside the purview of AS28, which is standard for impairment testing. Now we use the word impairment. There can be a very simple English translation also, which can give you an indication. So impairment is basically a diminution in the value of asset, otherwise than depreciation. As you are aware that depreciation is being charged to the profit and loss account on the basis of useful life of an asset. For example, if you purchase an asset for 1,000 rupees and the useful life is 10 years, then every year, 100 rupees is charged to profit and loss accounts. That's a depreciation concept, and there is a different standard which deals with the depreciation. And there are, guidance which are available in the Companies Act as well. So what is impairment loss? Every year we are reducing some amount, we are spreading the cost of that asset. But what is impairment? In case of certain assets, if their carrying amount is more than the recoverable amount, so you're showing asset at a value of 1,000, but recoverable amount is only 100. Then you need to understand and apply this standard to know whether there is a need of recognizing impairment loss. And then what is the carrying amount? Carrying amount is the amount which is mentioned in front of the asset in the balance sheet. So how your financial statements, what value you are giving in the financial statements to that asset is called the carrying amount. So one is the recoverable amount, the other is the carrying amount. So whatever is appearing in the balance sheet or your financial statement is the carrying amount, and recoverable value. Let us have a look at how we do the measurement of recoverable value. So recoverable value is higher of net selling amount price, and it's basically value in use. So that means I'll explain the concept a little more. So net selling price is the amount which is obtainable in case of sale of asset, but you need to reduce the cost of disposal. So that is your net selling price. So basically, you will understand the resources you would need, to sell that asset. That cost has to be taken on the best estimate basis, and sale price has to be calculated. So that becomes your. So to give you an example, so if you have an asset which is worth rupees 5,000, you know that if you have to sell this asset, you will have to take that asset to the market, and you will need to hire a commission agent. So your expenses will be 500 rupees. So your net selling price is 5,000 minus 500, which becomes 4,500. So sources and basis of selling price. How do you know what is the selling price? It can be binding sale agreement. It can be active market price, can be best estimates, on the basis of the information. There are various ways and means. So you say that, okay, company has taken value, X value, which is taken as a net selling price. I am going to do an audit of this company or this entity. How would I know that this is showing a true and fair picture or not? You as auditor will need to understand what is the basis on which they have calculated their net selling price. Whether they had taken, they have already entered into a binding sale agreement, or they had taken the comparables from the market, or they have just done a basic rough estimate. Whatever basis they have taken, you need to see, in case you are doing an audit, you need to see that that price has been arrived at, and the documentation is available, and you have enough evidence to support those documentation. Now, what is value in use? So there is present value. So this is an alternate to the net selling price. Many people, they use this nowadays, the valuation of entities, the business. So a lot of debate is happening on how is the value arrived at. So value in use, according to this standard, is the present value of estimated future cash flows expected from the asset plus residual value at the end of its useful life. The present value is calculated by applying the discount rate to the future cash flows. So whatever I am going to earn in future, if I discount that and bring it to the present value as on date, so that becomes my value in use. So what is your recoverable amount? It is net selling amount, price, and its value in use, whichever is higher. So that is the recoverable value. So you can have two parameters on the basis of which you will need to compare. So recoverable value can be net selling price, what I will get if I sell this asset. That's one way of doing. Net selling price will be taking care of expenses which are related to selling also. And the alternate method is to understand what is value in use. So you do a cash flow, future cash flow, and bring it to the present value, and you will come to know the value in use. So you will reach to a recoverable value, either of these, higher of these two, which will be your recoverable value, and you have to see your carrying value, which is appearing in the balance sheet. Now you say that, okay, my balance sheet is showing X, my recoverable amount is showing Y. Why should I do the impairment testing? So there can be, so this standard says that there are indicators which you need to see. To have those indicators, you will need to do the impairment. So these indicators can be external. These indicators can be internals also. So indicators which are external. So there are some examples. So let us say decline in the market value. There is a significant decline. So let us say you are having a machinery which was purchased couple of years ago, and it was assumed that that machinery will run for 20 years, the useful life. Now this machinery is making those papers which are used for film rolls. So you see the technology has gone up. People are no more using those cameras which were using those rolls. So now what will be the so there is a significant change in the market for that particular item. So you will see if your asset is there is an indication that there is a significant decline in the market value. Second indicator can be adverse effect of change in technological, market, economic, or regulations. So you may see that if that is the kind of indicator, if there is some economic, some regulation which has come, which is putting stress on this particular asset, you will need to see whether that is an indicator or not. There can be an increase in market interest rate. That can also be one of the external indicator. So external indicators are generally the indicators which are not controlled by the entity. They are external. So carrying amount of the net asset more than the market capitalization. So those indicators are there. In case you are doing an audit, and let us say it is a manufacturing entity, so you need to see whether there are any indicators which are external indicators or internal indicators which warrant that there is an impairment testing. There is a possibility of having an impairment loss. There are internal indicators also, obsolescence or physical damage. So if you have an asset and that asset has become obsolete, there are new developments which have happened and your company has moved into a different production line. So you feel that this will not be used by the company or there is some challenge. So you can take that as an internal indicator. Or let us say idle, the asset is lying idle, or plan to discontinue or restructure the operation, or if you plan to dispose of the asset, those are indicators of impairment testing. Or there is a decline in the economic performance of the asset. So there are external indicators, there are internal indicators. In case you are doing an audit, you need to see those indicators are there. The entity has got their impairment testing done, and that impairment, in case there is a loss, they have booked that loss into the financial statement. So how do you calculate that loss? How do you recognize that, and what is the way of doing a measurement of that loss? So if the recoverable amount of asset is less than the carrying amount, we have seen what is carrying amount, we had seen what is recoverable amount. So if the recoverable amount of the asset is less than the carrying amount of asset should be reduced to the level of recoverable amount. So you are carrying an asset at a value of 100. You realize that there is an indicator, and recoverable amount is let's say 70. So 70 is higher of both the methods which we have, net selling price or present value method. So you need to book 30 rupee as impairment loss in the current year, which is expense of the year you will need to. So basically you will need to take it in the statement of profit and loss as expense of the year, and you will need to mention impairment loss, and you will need to make a disclosure of the details, what were the indicators, whether those indicators were external or internal, and then how you have arrived at the impairment loss. In case you are doing the audit, you will need to see the documentation, how the company has arrived at that impairment loss. Once you have done the impairment booking of impairment loss, so you have reduced the value of asset in our previous example from 100 to 70. In future, your depreciation will be on 70. So that means your depreciation for future periods are to be adjusted as per the revised carrying amount. Now we need to understand, the cash generating unit. This is a very, very important concept in impairment testing. What is the meaning? What is the allocation? So a cash generating unit is the smallest identifiable group. So I will share with you an example where, the person is having a permit to drive 5 different routes, the buses, and one route is giving a loss. Then can it be treated? Can they do impairment loss booking on that route? But if they are connected, all the contract is for all the 5 routes, they cannot. Then all the 5 routes have to be taken as one cash generating unit. I'll be sharing that example with you in a very, very short while. Then allocation of goodwill and corporate assets to cash generating units should be done on pro rata basis. But first, allocation is to the goodwill and then to any other asset. So in case there are assets which are which are appearing in the financial statements, and goodwill is also there, so the first allocation will be towards the goodwill. Now this is an example which I was discussing with you. A bus company was providing service under contract that require minimum service of 5 separate routes, and one of the route was having a loss. And then because the enterprise does not have the option to curtail any one bus route, so the cash generating unit has to be taken as a whole. So in case, so this is an important part, that in case there is a development in the future, and in case there are indicators which are suggesting that the impairment loss no longer exists, the enterprise should estimate the recoverable amount, and whatever impairment loss was booked earlier may be reversed. Please be careful. May be reversed. It's not that shall be reversed. It's a different from shall be reversed. It's a may be reversed. So accounting standard is giving an option. In case you want, you can reverse that. But there are certain exceptions to this rule. So this guidance has got certain exception. So impairment loss which you have booked for goodwill, that is first, and subsequent external events has occurred that that reverse the effect of that event. There may be a possibility that in future there can be another event which can have another impact. So you need to understand that there are some exceptions also. So now coming to the disclosures, as I had mentioned earlier, what all has been done, how it has been done, why it has been done, all these answers should be there in your disclosure note. Separate information report has to be given for each segment. And in case there is an impairment loss reversal, you need to mention that as well with quite detail. And nature and basis of recoverable amount determined for recognizing or reversing impairment loss should also be given in the disclosure notes. So we could summarize this very, very important standard in half an hour. Thank you so much for your time, and I hand it over to Parminder ji for further proceedings. Thank you so much for your time.
Thank you so much, Parveen ji. Thanks a lot for a very elaborated and detailed discussion on this standard, which is very much relevant nowadays specifically. And since we have understood today PPE and intangible assets, so this was a very relevant topic to be understood along with those two standards. Thank you so much. So now I will invite our JS CA SN Gupta ji to conclude the session for his concluding remarks. Thank you, sir. Over to you.
Thank you, Parminder. Today's session was highly informative, knowledgeable, and very enlightening. The manner in which the pronouncement was taken by the Alu Gupta ji, very detailed. The difference between the old position versus the new position, very informative and very interesting. The concept discussed in AS 10 by CA Achal Jain ji, and the concept discussed in AS 26 and 28 by Praveen Kumar ji was very informative and presented in a very nice manner. So hope the participant would have enjoyed the session. I thank you once again, CA Alok Garg ji, CA Achal Jain ji, CA Praveen Kumar ji, for their valuable time and contribution in the journey of Accounting Standard Board. I hope everyone got the benefit out of it. Thank you very much, Office Parminder and team also. And thank you very much, sir. Thank you.
Thank you.